All right, hey, what's going on, everybody? Welcome to the Sprint Review. So just a quick intro of what this is. So this is a live stream that I do every 2 weeks, and it's a personal finance show that's based for tech professionals. So I mean, we'll be talking about stuff that is related specifically to tech professionals, and then other things that will just apply to well, more broadly speaking. Sorry, I had some technical difficulties, so I had to mute something real quick. So anyway, so quick introduction. My name is Mike Zung. I'm a certified financial planner, and I am the founder of Java Wealth Planning. It's a fee-only investment management and financial planning firm, and I'm based in Kansas City, but I work with people all across the country. And then yeah, so this is actually episode 7, which is kind of crazy to think that I feel like I just started a little bit ago and I'm already on the 7th episode. So yeah, so today what we are going to talk about, it is very topical from a tech professional perspective. So what we're going to be talking about is restricted stock units. So making the most of your RSUs. And so I've actually done a video that talks about the basics of it, just the way that RSUs work. We'll cover that again here, but then also we'll be going further in depth with what different planning things that you got to think about whenever you have RSUs. And so in order to do that, rather than me carrying the load by myself, I have brought in some extra expertise. And so today we have Jeff Branson joining, and I'll actually let Jeff do more introduction for himself. But Jeff and I we're both members of XY Planning Network, and we know each other through a study group that is specific around stock compensation. And so we talk a lot about different types of stock compensation, and so RSUs is definitely a big one, and so it's definitely a good idea to have some added expertise that Jeff brings. And so without further ado, can put Jeff on the screen. So Jeff, how are you?
Mike, how you doing? Thanks for having me, sir.
Yeah, no problem. All right.
Glad I could be here.
Yeah. So I guess first, before we get started, just to open the floor to you a little bit, and just to introduce yourself, kind of like where you're located, just whatever you want to share.
Perfect. Well, my name is Jeff Branson. I'm a financial planner. I own Branson Financial Planning. I'm also, just like Mike, a financial planner, investment manager, and tax planner as well. I'm located in Maine, but I work with clients all across the United States as well. And I do have a focus as well. I help folks in the equity compensation planning area more specifically. So that's why I'm here. Mike's a good colleague of mine, and we're happy to chat more about all things RSUs today.
Right. Yep. We just like to nerd out on this stuff all the time. So may as well do it live, like in front of a bunch of other people right now too.
Yes.
Yeah. Okay. Yeah. So really, just kind of, I guess a few things before diving into it. First, part of the reason why I do it, why I choose to do this live stream is to make it more interactive. And so if you're watching right now, and if you have any questions, then feel free to ask any questions, add any comments. So I will be, or I guess I'll be able to see them, and then I'll put the question onto the onto the screen, so we can try to address things as they come in, because otherwise it's just going to be us yapping away the entire time. And so we want to make this as
talk about who knows what.
right, yeah, maybe just put a comment and just be like, please move on, stop droning on about this. So yeah, so feel free to drop any questions. I see a good number of people that have joined live, which is great. And then the other really important thing that I need to do is give the disclaimer. So first, the disclaimer is that this is only general explanations and education. It is not specific tax, legal, or investment advice. And before considering acting on anything that you see in this video, then first consult with your tax, legal, or investment advisor. And if you don't yet have one, then that's where we would also come in. We are both taking on new clients. So so yeah, if you need anything, then feel free to reach out to either one of us, and then we can either see if either we'd be a good fit or if we can find you a good fit, because that's a whole other topic that I could talk about of that finding the right financial planner for you, right? Finding someone that's actually the right fit, because I know I'm not the right fit for everybody, and Jeff, I'm sure you would say something similar.
Yes, absolutely. We both have our niches, and we both work with a specific clientele, and that's incredibly important. And I feel passionately about that too. It's one of the reasons why we work so well together, Mike. We know that not every financial advisor works with every client, and that's important. But yeah, anyways.
Right. Yep. Yeah. Okay. So yeah, let's dive into it. And actually, I was just going to kick it off, but there's actually a comment here that would just be a perfect way to kick it off too. Let's see if I can do this. So we have a question that just says, I am a newbie. Can you define restricted stock, and why does it or does it not matter? Well, that's exactly what we are going to be talking through here. And so yeah, I guess part of the me just shirking responsibility onto Jeff, I'll kick it off to you to say, so give me the, what's your elevator pitch or quick of like, what are RSUs?
Yeah, absolutely. RSUs are basically, think about it this way. They're a cash bonus, but in the form of stock of your company. And just like any other cash bonus that your company is going to give you, if you work there over a period of 3, 4, 5 years, well, they're not going to give you 5 years worth of bonus all up front. They're going to pay you a little bit every single year. And that's essentially what RSUs are. There's a restriction on them in that they're not going to give you the stock all up front. Your company is going to instead give you a little bit of stock every single month or every single quarter or maybe every single year. And then from there, the stock will continue to vest as time kind of moves on. That's essentially what RSUs are. They're essentially a cash bonus, but they're in the form of a stock. If that makes sense. That is my elevator pitch on RSUs. There are, of course, tax implications we're going to get into today in terms of how you should handle your RSUs, but that's essentially what it kind of boils down to when it comes to your company kind of giving you your RSUs.
Right. Yep. Yeah. So yeah, just kind of breaking it down, like that restricted part. Right, so it's like it's restricted because you actually don't get it yet, right? There's restrictions, there are strings attached to you being able to get this stock, right?
Yeah, exactly. Your company's just not going to give it to you straight up. Your company pays you usually every 2 weeks. They're not going to give you your full salary all up front. That's restricted in a sense. And your stock is restricted in a very similar fashion. You have to continue to work here in order to be given this stock. It's kind of like saying, hey, we're going to give you 10,000 shares up front. No, we're not going to do that. Instead, we're going to give you 1,000 shares maybe in a year, and we're going to give you another 1,000 shares every single quarter until that 10,000 kind of runs out. It's a way for your company to essentially give you some, golden handcuffs light, essentially a way for you to kind of stay at your company kind of longer. That's one of the many reasons as to why a company would give you RSUs. It's also a way for you to participate in your company's gain. As your company does better, the price of the stock goes higher. So when those shares vest down the line, you're essentially given more money if you are granted shares.
Right. Yeah. Actually, I have never thought of it like that, where you said your salary is restricted. Like you're not going to get your salary the entire, all at one time. So yeah, thinking of like, hey, whenever you get an offer letter, you say it's like, hey, your salary is, we'll just, it says $100,000, right? So it's like, oh yeah, you're not going to get 100 grand like dropped in your lap at the same time, right? And so yeah, for RSUs, it's a similar thing, except for it's almost like quoting your salary or quoting like this other cash award through, but it's over like a 4-year period. So that's why it's I guess on your salary you could say the same thing, where it's like, hey, I make $400,000 over a 4-year period, right?
Yeah. Exactly, but it sounds really weird. But for some reason, with With stock grants, you have to sign the grant agreement, of course, and then they're going to tell you, we're going to give you, X amount of shares. We're just not going to do it all up front. Sometimes companies
Right.
will, as a bonus for signing on. That's very possible, but majority of the time they give it to you over X amount of years to kind of entice you to stay longer at that company.
Right.
Yeah.
Right. Yeah. Okay. Cool. Yeah. So then let's see. We could go one of two ways. We could either say like, okay, actually, yeah, we'll go down the tax route right now. So, and you kind of alluded to it, and actually, what you were just saying with, making the analogy with your salary. That I guess you want to explain just the way that RSUs are taxed.
Yeah, absolutely. So similar to a salary, think about if we're going to pay you $100,000 a year, but you're only going to get taxed, every 2 weeks when we actually do your paycheck. If you quit halfway through the year, you don't get taxed on the rest of that salary. It's similar to RSUs. As your RSUs are given to you, you're given, let's say, 1,000 shares up front, but we're only going to give them to you at the end of every year. We're going to give you 250 shares because of the fact that there's a restriction, and it's going to be a time-based restriction. You work there a full year, then we're going to give you 250 shares. Well, when the stock vests at the end of the first year, for an example, you're going to be taxed on them giving you 250 shares. So if the stock is $10 per share on that time date, when you're given the shares, you're going to have an extra $2,500 in taxable income in that year. Also subject to FICA taxes because it's considered compensation income essentially.
Right. Yeah. Yeah. So kind of to that like just maybe we're just going to keep this analogy going the entire time. But yeah, that similar to your paycheck. Yeah. As soon as it vests, right, then it's like you just got that as income, and so you owe federal taxes, you owe state taxes if of course if you're in a state that has that, and then FICA. So Social Security and Medicare gets withheld too. Right.
Yep, and that can make things, if you think about it, kind of tricky. Let's say you're getting your RSUs vesting over a quarterly period. Well, I know how many shares I'm going to be getting every single quarter. One thing I don't know, and here's the $1,000,000 question: how much are the shares going to be worth per dollar share
Right.
When they actually vest? If you have a very volatile stock that's worth $50 one day, and the next day, it's worth $100, and then the next quarter it's worth $300. That could make planning very, very difficult, especially if you have other types of income that you're kind of planning for kind of throughout the year.
Right.
That's what makes RSUs very, very unique. It's easier if you're a salaried employee to plan for what your salary is going to be for the entire year. RSUs add in an extra layer of complexity because of the fact that you don't really know exactly how much your stock's going to be worth throughout the year.
Right. Yeah, and we'll get a little bit more into kind of the advanced stuff of like playing with your tax rate and like different ways that you can try to move it, try to adjust your income essentially. But yeah, actually, before getting into that, a little bit more just so we talked about how it's taxed, right? And of like how much taxes you owe. And so then from a mechanical standpoint, like how are the taxes actually withheld?
Yes, the withholding is incredibly important. So you have a number of different options in terms of how you're going to handle the taxes come vesting period. So now you've got this extra amount of income, and continuing with our salary example, when you're paid every 2 weeks, your company withholds taxes, right? It makes it super easy. You don't have to think about it till when you file your taxes, plus a few other things, but that's generally how it works. When it comes RSU vesting time, you have to pay taxes right at that time. There's a couple different ways you can do this. The most popular way, or I should say the most basic way of doing it, is to actually just pay in cash. So your stock vests, it's going to require a federal income tax withholding, which the supplemental rate for the overwhelming majority of people is 22%. So let's say $1,000 worth of stock vests at one time, you're going to owe 22%, $220 right at that time. Plus, you're going to owe any FICA taxes at that time as well. And I believe FICA taxes you can't pay in cash. I believe the federal income taxes you can, but you're going to have to owe it right there. So cash is one way. Another way, the most popular way, I would say, is really through a cashless exercise. So your company is going to sell off enough shares to cover your federal income tax withholding. So continuing with the same example, you've got $1,000 vesting. Let's say they're $10 per share. That's 100 shares. If you need to withhold $220, the 22% supplemental rate, to cover that, you're going to have to sell off 22 shares? 22 shares in order to cover that tax withholding, if I did my math right there.
Yeah, yeah, I
And that
think
way, you walk away with your 78 shares and you don't have to worry about taxes, at least for now.
right,
If you're in a higher, kind of getting ahead of ourselves, but if you're in a bigger tax bracket than the 22%, when it comes to actual tax filing time, you should have potentially withheld more. And there are a
right,
number of different ways of doing that, making quarterly estimated payments, increasing your W-4 withholding to a flat supplemental rate. There are a number of ways you can kind of do that.
right, right. Yep. Yeah. Yeah. And so I guess just to like for someone that has RSUs, if you know their schedule of their vesting schedule to say, hey, I get 100 RSUs, on this date, right? But then whenever that you look into your brokerage account where those RSUs go, then yeah, rather than seeing 100 that you own, it'll be like, oh, I only have 70 or 65 or something like that. And so what has
Yeah,
happened is that yeah they've withheld some of those RSUs, some of those stock to cover the taxes for it.
yeah, exactly. And the million-dollar question is, what should I do? What's best for me? It just kind of depends.
Right.
The third option, of course, is just selling everything right when it vests. Depending on what your goals are and what you're trying to accomplish, maybe not holding onto the stock is the best idea.
Right.
That is a whole nother conversation in itself in terms of what your goals are, what your objectives are, what are you trying to do, trying to save for down payment on a home.
Right.
You just trying to diversify out of your position. A number of different things you can kind of really do.
Right. Right. Yep. Yeah. Yeah. So I mean, yeah. So we kind of jumped from just the tax withholding part. Then yeah, yeah. So just getting into the next piece of it is okay. Now that your RSU's vested, the taxes were withheld, and now I have these shares in my account. Right. I think a common misconception is that if I if I sell there, then I'm going to have to owe more taxes, right? But I think just to clarify is that if you actually sell right away, there's no additional taxes. You've already paid your income taxes that through them holding back some of the shares.
Yeah, absolutely. It makes it easier in a way, in that
Yeah.
you don't really have much choice over this in terms of what's happening once they vest. It's similar to just giving a cash bonus, but it's just in the form of
Right.
stock. And that's why I always use that example in that,
Yeah.
once it happens, then if you wait after it vests, yes, you're going to be subject to capital gains if you hold on to it. But if you just want to keep things simple, you could just sell the entire thing at that exact moment. And you
Right.
never have to worry about, managing that concentrated position ever again.
Right. Yep. Yeah.
But
Yeah.
that's a,
The
it's a,
so- Oh no,
I was
I was
just,
just
I
gonna
was
say
just,
oh man, now there's the delay and we're doing this thing, so I'm gonna go now. Um,
yeah,
so yeah, the way that I've heard it and that is most convincing to people of whether like once it vests and they have the stock in their account, whether they should sell it or not, is posing the question of, I guess in our example, if you had I guess $7,800 that you got that hit your checking account from a bonus from your company, would you turn around and take that full amount of money and go out to Robinhood or E-Trade or whatever and go buy your company stock with that money?
yeah, and it's such an interesting question because it goes both ways, right? I mean, if you were advising somebody in 2015, 2016, and they were getting RSUs from Amazon or Apple or,
Mm-hmm.
something similar, I don't want to say you look like a dummy, but
Right.
it wouldn't be, I guess you can say, quote unquote, good advice. But I think it's important to make that decision based on what's best for you and not exactly
Right.
what's, what the market is potentially going to do. And I think
Right.
you'll sleep better at night, knowing that I'm making this decision based on, the fact that I want to put a down payment on a home right now, and I don't want to risk that based on how my company performs. And I
Right.
think if you, oh, did I lose you, Mike?
Nope, I'm still
And
there.
I think if you, oh, there you are. And I think if you pose it kind of that way, it makes it a little bit easier because
Uh-huh.
we of course all have our biases, and I think the biggest one in this situation is kind of the FOMO, right? Not only just in the
Hmm.
gains in general, but just in the fact that you don't want to miss out, and then all of your colleagues, they didn't sell, and now it
Right.
it double hurts because now they're participating in all of this. And there's nothing wrong with doing nothing wrong. Actually, it's a good approach to do kind of a combo approach where you don't have to sell everything all at once, and you
Uh-huh.
don't have to keep everything all at once too. You can do kind of a middle approach, which I think
Right.
is really popular. You still get to participate in the gains of your company by holding on to some stock. At the same time, you still get to potentially diversify out, use that money for paying down debt, down payment on a home, or just diversifying just in general.
Right. Right. Yep. Yeah, I know it is definitely a difficult conversation that I know that I've had to have with clients of of they'll come to me and like, oh, I have these RSUs and I haven't done anything. They've just vested and I've just held them. And if we look back, it's like, well, it actually worked out really well for you because just in this last year, things have gone up quite a bit, right? And so that's why it's a difficult sell from our perspective of say it's like actually you should do this, but it's funny how whenever you pose that question, like almost to a person, that there's just like, oh no, I wouldn't go do that, right? So, but essentially that is what you're doing by holding on to it after it vests,
Yeah, and hindsight's 2020, and
right?
sometimes you'll drive yourself insane by holding
Yeah,
on to it, and then it goes up, and then you have the bias of it's gone up, so why would I sell now? And then you have the opposite
right.
bias of it's gone down, and now you're like, oh, I want to wait till it comes back up to that last price before I sell it. And
Yeah,
there's no guarantee that either one of those are going to happen. So
yeah,
sometimes you're doing your emotional and mental self a favor by just at least doing a combo route, selling some of it, um,
right.
and holding on to the rest.
Yep. Yep. Yeah. Okay. Yeah. So actually, one other thing to point out, just from that tax withholding perspective, is so you had mentioned that for the lion's share of people, what is automatically going to get withheld is 22% on like
Yep.
from a federal tax rate. But so that's where it gets into that's one level of hey, whenever what does planning for RSUs entail? And so I think one of the big ones is understanding that if they're withholding at 22%, but you actually make your household makes enough to where you're actually in the 32-35% tax bracket, something like that, right? Then that's really important to know so that you you either pay estimated taxes, or that you like or you're saving that money and you say like, hey, I know I need to withhold another 10% for taxes of this.
Yeah, absolutely. That's incredibly important. Otherwise, you're going to have a surprise tax bill come April 15th, and nobody likes that.
Nope, nope, yeah, you definitely don't like that. um, okay, cool, let's see. I was figuring we'd get a little bit more into some of the advanced stuff, but before doing that, I was thinking I just wanted to make sure from your perspective was if there was anything else. I was thinking of like coordinating with ISOs and non-quals uh, and charitable contributions and things like that. But
Yeah.
before getting into all that stuff, was there anything else that you had that you wanted to touch on?
Um, should we do the difference between RSUs and actually restricted stock?
Yes,
Yeah.
yes, we
So
should.
most people will. Restricted stock units and restricted stock, or also called restricted stock awards, are different. They're two different things, and they sound very, very similar because they are. But there are differences in how they are treated from a tax standpoint, potentially. Restricted stock units that we keep talking about, nothing more than a cash bonus, right? Pretty straightforward. Restricted stock is the same in that they're giving it to you, and there's going to be some restrictions, and it's going to vest potentially in the future. And they could have the same vesting requirements as RSUs. But the biggest difference really has to do with taxes, of course, and how it's treated with the IRS. So you have an option with restricted stock. It's called an 83B election in terms of you wanting to pay tax on the value of the full grant or partial grant right when it is granted to you with restricted stock. You cannot do this with restricted stock units. The upside of doing something like this is that with restricted stock, if you pay the tax now on the full value, well, if the stock goes bananas and goes way up in the future, when it vests in the future, you don't have to pay any taxes on that amount because you already did right at the beginning when it granted. So that's the big advantage. The downside, of course, is that you can pay the tax now and then it's potentially worthless in the future. So it's kind of a risk, but that is the big, big difference. And you see that question pop up a lot of 83B and whether or not it's a good idea. It just kind of depends. It's really, really important. Last point. You need to do the 83B election within 30 days of your restricted stock grant. That's incredibly important. You got to do it quickly. So once they're granted to you, you should be talking to your tax advisor, financial planner, or whoever about whether or not you should be actually doing this.
Right. Right. Yep. Yeah. Yeah. And then I guess with as far as other differences between RSUs and restricted stock, oh, either I froze up or you froze up, but I don't know. I'm going to blame you on it. So, but yeah, just anyway, I was going to talk in this part anyway. So as far as the restricted stock versus RSUs, a couple of the other differences that might be a little bit more on the minor side is around paying dividends. So whenever you, I think we lost Jeff. He'll be back in a little bit. I'll fill him in. Actually, he knows all this stuff anyway. So with restricted stock, that is different than RSUs. Is that you in a way you actually do own this stock, right? Hey, you're back.
I'm back. There I am. Sorry.
Okay, that's all right. I was launching into the whole a couple other things about restricted stock versus RSUs anyway.
Didn't miss anything then.
Right. Yeah, I know. I was just blabbering on. No. So yeah, a couple of the other differences is that whenever you actually have restricted stock, then you actually get paid out the dividends. Like you actually have rights to the dividends. But for RSUs, you like that's what the unit part is. It's like you don't actually have the stock. It's like it's a promise. It's an IOU of that you're going to get this stock.
Yep.
Right. So yeah, but that's one thing for restricted stock, that you get the dividends, and then like what you were saying with the 83B election, which actually is bearing the lead a little bit for our Reddit question of the day, or the week, or the fortnight. So, and then the other thing with restricted stock that is very minor is like having voting rights. Like you're actually a shareholder in that sense. So yeah, but yeah, that's definitely good, because I mean that can get really confusing for some people as far as like I have a RSA, or just restricted stock, and so just understanding that it's still pretty much the same with a few of these minor differences.
Yep, absolutely.
Yeah. All right. Okay, so let's get a little bit more into the weeds. So as far as a few of the advanced planning topics to think about whenever you're thinking about having restricted stock, or whenever you do have restricted stock that's vesting in the year. I guess the first one that I was thinking of is around different ways of lowering your income. right? Because whenever you have RSUs that vest, like if there's a grant that is vested, you have a lot that's vesting in 1 year. Again, similar to the income perspective, it's just like you just got like a big fat cash bonus, right? And it makes your income skyrocket. And actually another way that to touch on is um, if you have RSUs in a company that went public, right? Without going into all the details, I have a whole other video that talks about it, so everyone go watch that. There's the possibility where even though it's vesting from a time perspective, it doesn't technically vest and become income to you until you go public. And then like at that point, then there's just this huge cash influx of income because of all of your RSUs vesting at the same time. Right. So I guess maybe turn it to you of what are some of the main ways to try to help lower your income, to lower your tax bill.
Yeah, some of the big ones are going to be your 401k, of course, your pre-tax contributions, making sure you are maxing it out. If not, if you're getting RSU income and you're not maxing out your 401k, well, maybe you should be. And on top of that, making sure, hey, if I'm doing 50-50 between pre-tax and Roth, well, if you're getting a little bit more in income that you're comfortable with, and it's pushing you up into a 32% bracket, maybe it makes sense to now switch to 100%, or
Right.
maybe an 80%, 20% split between pre-tax and Roth. Those are the two big ones, because I think a lot of folks are doing Roth and they don't really realize it. They kind of think it's all the same thing, but there's a huge difference. And if you're getting extra income, those 401k contributions can absolutely help. Other ways are going to be if you're itemizing, you can do charitable contributions. If you have low basis stock from maybe a stock option plan, maybe you want to donate that instead of the cash from the RSUs. That could be an advantageous way. Your HSA, that's another way as well.
Yep.
That's pre-tax as well. Those are some of the big popular ways to kind of lower your income, for sure.
Right. Yep. Yeah. Perfect. Yeah, and then I guess one other kind of quick part for whenever you're itemizing deductions and trying to donate, because right now the standard deduction is actually pretty high. It's $25,000 for a married couple, and so the majority of people just take that standard deduction. But whenever you're taking the standard deduction, then your donations actually aren't lowering your tax bill at all. But there's the strategy of trying to like bunch or stack your charitable contributions all in 1 year, so that in that year you're actually breaking through the standard deduction limit and itemizing, and then able to lower your income from that perspective.
Yeah, that's really important. So if you're doing like $2,000 a year towards your favorite charity, maybe it makes sense to do, if you have the cash flow and cash in hand, 5 years worth and do 10,000. Maybe that pushes you out of the standard deduction.
Right.
Now you're itemizing, and now it makes sense to do that. Yeah, that's a good, very good point.
Right. Yep. Yeah. And you have more resources to do it because you just got a whole bunch of RSUs that vested.
Yes, put that money to work.
Yep. Okay. Yeah. So perfect. So then, actually, similar. I think that dovetails pretty nicely into one of the other more advanced topics. Is that, and let's see how we can do this without launching into everything about non-qualified stock options. But so it's a similar thing with like if you also have non-qualified stock options, just the strategy around like playing with your income between the RSUs and the non-quals.
Yeah, the beauty about the non-qual is that you have more flexibility and control about when you're going to recognize the income. There are vesting requirements. Without getting into details, there are vesting requirements with non-qualified stock options, just like with restricted units. But the big difference between a stock option and equity compensation like RSUs is that RSUs you don't really have much control at all. It just happens. It's great. You get a cash bonus. Blah blah blah. But with non-quals, you actually have to exercise it. So when you actually exercise those stock options, you need to be really careful, because if you're getting an RSU at the same time, you could be bumping yourself up into a higher tax bracket. If you're thinking about exercising at the beginning of the year, your non-qualified stock options, and your RSUs are like $20 a share, and then your company just takes off, you have really good earnings, and then all of a sudden it's now $80 a share. Well, instead of being in the 24% bracket, now it just pushed you up into 32 or the 37 or whatever bracket, way above and beyond, and you weren't prepared for that. Now your RSUs are actually taxed at a potentially higher bracket, and the same thing with the bargain element on your non-qualified stock options. It all kind of pushed you up into that higher bracket.
Right. Yep.
Yeah. You're left with a big tax bill on April 15th.
Right. Yeah. Although I feel like I always have to make this clarification for people of like, paying more taxes. Yeah, it stinks, right? But then you also got to put it in the perspective of just like, you're paying more taxes because you made a lot more money, right? So there's always that distinction too. But yeah, so actually, I've never really I feel like your analogy at the beginning of RSUs being just like income that is deferred, like similar from a non-qualified stock option perspective. And this is the first time I'm making this analogy, so it might fall flat. But we're good. But I mean, what better time than live
doing it live
YouTube, right? So thinking of a non-qualified stock option it's almost like it's another paycheck, but you can control when you actually tell your employer when you want to take it home, right?
Absolutely, that's a great way of doing it. Yeah, because you have the option of when you want to exercise it and recognize the income. The stock options, you only recognize income when you actually exercise them.
Right.
And you might be better off, in terms of creating wealth. That's what concentrated positions essentially do, using the proceeds from your RSUs in order to exercise and pay the taxes on the options, because you're essentially using leverage. So it's going to give you more of an upside, kind of long term.
Right. Yeah. I guess so. Doing that as opposed to needing to use some of those options to cover the exercise cost and the taxes on it.
Yeah, potentially. That's one way of looking at it.
Yeah. Okay. Yeah. Cool. All right. I guess before moving on to the ISOs, anything else on the non-qualified stock option planning?
Yeah, just be really careful, really know your tax situation, come November / early December, really do a deep dive on how much you paid in taxes to date. So if it makes sense to exercise your non-quals at that point, you have a really good idea of how much they're actually worth.
Right. Yep. Okay. All right. So then moving on to this will be switching gears some of like, so if you have RSUs, but then you also have incentive stock options, right? And again, whole other subject of what incentive stock options are, but we're gonna, like, if you don't know, pause here, like bookmark it somehow, and then learn about it, and then come back here. So, but from the perspective of if you have both RSUs and incentive stock options, then what are some of the things to think about whenever you're coordinating these things?
A lot to think about. Incentive stock options, how they operate are similar to non-qualified stock options. The big difference is that incentive stock options are an AMT preference item. So basically, when you exercise your incentive stock options, you're not going to pay ordinary income tax based on the bargain element of the incentive stock option. Instead, it's going to be an AMT preference item. And most people don't know this because most people don't have to deal with AMT, but your federal taxes are calculated two different ways. You have the alternative way of calculating it that's subject to the alternative minimum tax, and then you have the federal income tax. And there are certain items that are called quote unquote phantom income that generate income that is subject to the AMT. And one of those is the bargain element of ISOs. And if you have more and more bargain element when you exercise your incentive stock options, you could pay potentially AMT. It's not a double tax. It's a way of kind of prepaying your tax without getting too off topic with RSUs. So essentially, long story short, what you need to be careful with is that when you when you have RSUs that are vesting, it could change how much AMT you potentially could be subject to. And it kind of depends. Sometimes when you have more RSUs and more income, the spread essentially between paying AMT and not paying AMT, sometimes it increases. So you're able to essentially exercise more ISOs without having to pay AMT, kind of without getting into the weeds there. So basically, your RSUs are going to change that number of how much you can essentially exercise with ISOs. I don't know if I did a good job explaining that. That's a tough one to kind of do in a nutshell. You could do a whole nother video just on that whole strategy.
Oh yeah. I mean that could be another like 2-hour series of doing that. And after I said that, and I'm listening to you, I mean everything you said, like it's spot on. But I realized that it's like I just asked maybe one of the most difficult questions.
Explain AMT in 30 seconds, yeah.
Right. I know, yeah. So it's like I have a video that tries to explain AMT and like how ISOs do it. And I mean it's like 9 minutes, right? So I just said it's like, hey, do this, and then like a separate video that explains ISOs in 10 minutes. So you did a pretty good job for 2 minutes on all of it. So
yeah, sure to sum it all up right there.
Yeah.
Long story short, talk to a tax advisor, right?
Right. Yeah. In a way, yeah. It's like this is how we're advertising ourselves. It's just like, hey, this is why you need to actually talk to somebody about. So either, I mean, talk to somebody, or like if you're a do-it-yourself person, then it's like if you feel passionate and you want to learn about it, then the information's out there, right?
It is.
So
it absolutely is.
Yeah. But so just kind of trying to bring it back to like if you have ISOs too, that like whenever you have RSUs, if RSUs vest, then it's like that's bumping up your income, right? And so in your incentive stock option world, that changes the calculation of like how much you can exercise without hitting AMT yet. So like you kind of think of it as like they're going up together. Right, so it's like, hey, I got more RSUs. Hey, I actually could exercise more ISOs before I hit AMT, right? So
yeah, and it changes things with we just talked about it, itemizing deductions. Are you going to accelerate some deductions this year with charitable contributions to potentially lower your AMT? Are you going to divert it now to the next year? All these things, as you can imagine, kind of play in together. That's why doing tax projections, at least maybe once at the beginning of the year and once at the end of the year, make the most sense.
Right. Yeah. I mean, getting into this. This is a little bit of inside baseball, but getting into just this world, because I'm a career changer, right? Like I came from tech, right? And so I kind of came into financial planning and what I thought it was versus like where the value really is. I thought it was like, going to be a lot of, just like preaching Dave Ramsey or something like that, right? And I mean, there is definitely the behavioral part of it, but whenever it gets into stock compensation planning, like so much of it is just like around like navigating taxes, right?
Yeah, pretty much everything at the end of the day comes back to taxes, and that's why it's so super important. If you're focusing on this, this niche, you got to know your ins and outs with the 1040 and with the IRS. It's incredibly important.
Right. Yep. Yeah. And I guess a shameless plug for you. You're in the process of getting your enrolled agent designation right now, right?
Yes, that should be done here in a month or so. It's August 5th, I think. Part 3 that I have to take will be the last part. And yeah, about a month or so. So I'll have the enrolled agent designation. So dedication to knowing taxes, anything and everything.
Yep, definitely. Okay. All right. Let's see. So before going into the Reddit question, is there anything else that we want to throw out there specifically on RSUs?
Yeah, you kind of mentioned it earlier. RSUs are pretty popular with pre-IPO companies. Be very, very careful when you're accruing RSUs in a pre-IPO company. Everything we've kind of talked about to this point has pretty much been from a public company standpoint. The stock is readily exchangeable and traded on an exchange. When you're pre-IPO, that's not the case. And a lot of times The vesting that we talked about to this point is just time-based, right? Well, you could have a unique vesting feature in pre-IPO companies. There's time, so you have to work there long enough, and the next one is liquidity, right? So there has to be some kind of liquidity event, such as a merger, an acquisition, or the big ones, an IPO. And when that second vesting situation happens, all of your RSUs will vest at that very moment. So if you've been accruing RSUs the past 3 or 4 years, and then your company goes IPO, you're going to owe a ton in taxes right at that very, not at that very moment, but you're going to owe a ton in taxes for that year. So you have to be very, very careful. And it gets even more tricky when you talk about, my company just went IPO. We just had a blackout period. Now I can't even sell my RSUs, and now I owe a ton in taxes. How am I going to come up with this? I owe $100,000 in extra federal taxes. How am I supposed to pay for this? So you got to be really, really careful planning wise, because sometimes there's nothing you can really do about it. You just have to plan for it.
Yep. Yeah, I think was that Uber? I think was kind of the one that was in the news a lot, where whenever they went public, so they IPO'd, and that second trigger was that IPO date, and their stock was up, right? And so as far as from an IRS perspective looking in, they say, okay, all these people just realized this much income, right? And so it's like, this is what their income set at. But then, they had this blackout period where they actually, even though it vested and they realized the income for it, they couldn't actually sell it at all, right? And so there's this blackout period, and then at the other end of the blackout period, the stock price went down, right? So whenever they actually could sell it, like, it took so much of their equity to just pay the tax bill for it.
Yep, and sometimes there's nothing you do about it. And I think it was either Uber, Airbnb, or another one. I can't remember. But it vested, or they IPO'd in December, and then there was a 6-month blackout period. Well, if all of that income is recognized in December, and then all of a sudden you have a 6-month blackout period, which you can't sell, and it goes past April 15th, where you're kind of stuck between a rock and a hard place there. And what do you do?
Right.
April 15th comes, you can't, you just do what you can, sell any other assets, or sell, or get ready to pay for a big tax bill come that tax time. And then if it goes down, like you said, that's even worse.
Right.
But hopefully you made overall net some cash. So not the worst thing in the world, but definitely from a tax standpoint makes it difficult.
Right. Yep. Yeah. So if you're out there and you have RSUs and your company's going public, then make sure that you understand how and when it's going to get taxed, or like when it's realized income, right? When it actually vests.
Yeah, we're smiling as we say all this, but I know that's your case.
So thanks.
Yeah, I'm aware. I'm going through that. Yeah.
Yep. All right. Okay. Cool. So let's go into the next segment. I was saying in the last one, I need to create like some kind of bumper video that goes into the Reddit question of the week section, right?
Oh yeah, you do. You need like a song or something.
Right. Okay. So what I'd like to go into Reddit, the personal finance sub. Because there's a lot of good questions. It's all anonymous, so I don't really feel like I'm outing anybody and showing this stuff. And then I like to try to address these questions, because sometimes there's good information that's out there, but then just like anything else on social media, like it's be wary of knowing of where you're getting your financial advice, right? Or financial education. I can't call this financial advice. Right?
Yes.
Yeah. Yep. So this question is around the 83B election, which Jeff you had touched on earlier. So this person says, wondering if anybody has any experience filing an 83B for their RSUs. So this says a general employee for a large corporation. It's like, I'm just a general employee. I expect my vest price will be significantly higher than my grant prices, and thus looking for a way to reduce my future tax burden. Any advice with filling this out? And they actually call out that getting it filed within 30 days of the grant. Right.
Yeah,
so,
This person's
Yeah,
so
sorry, go ahead.
close, right? I mean, they've almost
Yeah.
got everything nailed down. The 30 days, paying taxes now. Um, but if anybody has any experience filing an 83B for their RSUs, there's not a single person on earth that has experience doing that because you're not able to do that. You can only do it for your restricted stock. So 83B is only done for, we talked about this earlier, restricted stock. RSUs you can't do in 83B. And the thinking behind that, if anybody's curious, is the IRS, when you're given restricted stock, the IRS deems that you own the restricted stock. With the restricted stock units, it's just like your paycheck, like we've been saying. You don't own your future paychecks, therefore you're not taxed on it until you receive it. So that's why with an 83B, you're able to actually pay taxes on something that you own with the restricted stock awards. Restricted stock units, you don't own the stock there. Sorry, I don't know if I stole your thunder there, Mike.
No, no, that
Works.
was all the thunder in this question anyway. So, yeah, and well, and I guess, but to the point of like why you would like at, I guess first changing that RSU to restricted stock, right? So it's like that's the only time that you can do this. But then if you do have a restricted stock, then saying like why would it make sense to do the 83B election, right? And they kind of alluded to it here as well, of that it's as much of a gamble really that says like I believe I'm betting that this stock is just going to go up, right? And so I want to realize and pay the taxes on what I feel like is a lower number.
Yeah, absolutely. That's what it is. You feel like the stock is going to go up. The flip side is that, or not flip side, but coinciding with that, is either A, you feel like the stock's going to go up, or B, if you feel like just your income in general is going to go way up in the future.
Yeah.
Restricted stock has restrictions for, what we've talked about this to this point for just time, but you could also have a restriction based on performance. So if you're in sales and we're not going to pay you this stock until you work here for a year and until you sell 1,000 widgets. Once you are there for a year, you sell another 1,000 widgets. Then at that point, you can your stock vests. So that's something else to kind of consider as well. But generally speaking, you should only do it if you really think. Well, essentially, you should only do it if you think the price is going to go up. But that's the big one: is if you think the price is going to go way higher, kind of in the future.
Right. Right. Yep. Yeah. That makes total sense. And actually, I actually hadn't thought about like if you think your income in general is just going to get higher, right? So that it's like okay, let's try to let's pay the taxes now while my overall income, because like all this stuff that we're talking about with the restricted stock and the non-qualified stock options, it's basically all coming down to how much your overall income is going to be put onto your tax return.
Yeah, that's exactly what it is, and that's the $1 million question, right?
Yeah.
Especially if you're working like in tech sales or something, or if you're you're receiving non-qualified options and you're a consultant and your income's a little bit all over the place. It could just be kind of difficult sometimes, and that's why it's important at the end of the year to kind of get a good idea of what your tax situation is going to be. That way, it makes sense. Do I exercise now? Do I try and negotiate, for my RSUs to be vested in a different date? You just have a little bit more planning flexibility.
Right. Yep. Yeah. Good. Yeah, that's good stuff. Okay. Well, see, I told like we're basically at an hour right now. Just kind of breeze right through it. Right. Okay. So yeah, that was a boatload of information. So hopefully that it has resonated with everybody. So first, thank you for coming on, and I totally dumped a ton of the heavy lifting to you, and so I fully appreciate it.
Absolutely. Thanks for having me, Mike. This was fun.
Yeah. Yep. Yeah. So I guess the last thing before we go, where can we find you? More information about you?
Yeah, absolutely. BransonFP.com or just BransonFinancialPlanning.com. All of my contact information is there. I got a blog that goes over some fun stuff that we're all talking about here, but it's not as cool as Mike's videos. So if you need more stock hop stuff and you're looking for good explainers, Mike's your guy.
Well, it's people take in information differently. If you're in a public place, you can't just be watching videos all the time. So
Cool. Well, thanks, Mike. This was
Yep.
fun.
All right. Yep. Thanks a lot. And yeah, everybody else, thanks. I'll be back in a couple weeks and be talking more stock comp stuff probably. So, all right. See you guys soon.
See ya.
Bye.